ठीक है स्टूडेंट्स, डू लेट मी नो एनी अदर एरियाज टू बी कवर्ड. मैं जल्दी से कवर कर लेता हूँ. So students, NRTP practicals में I will be doing the methods of the determination of ALP and thereafter students the CG amendments. Okay, CG amendments. First of all students, in the case of the NR, let's start with this one. पहले पॉइंट पे अगर आप देखोगे, if you will find in the very first point, अच्छा you want me to do it in English or Hindi students? Quickly. किस पे करूं, हिंदी में करूं या इंग्लिश में करूं? English praising, let's do that in English. So students, in this context, English Samnath, perfect. So I'll do first students the indirect transfer, the first one. Residential status students, you can do it after the lecture gets over. Residential status, only 2 points of individual residential status students, just keep that in mind. 2 points of the individual residential status students, just keep that in mind. And that is, I think all of you, is the amendment of the last year. Abhishek, the amendment of the last year students. So if you know the amendment of the last year, if in the case of a person of an Indian origin or a citizen of India who comes for a visit in India, students, he is coming for a visit in India and his stay is for a period of 120 days or above in the current previous year, and his total income excluding the income from the foreign source is more than rupees 15 lakhs. His total income excluding the income from foreign source is more than rupees 15 lakhs, and his stay in the last 4 preceding previous year should be minimum 365 days or above. His stay in the last 4 preceding previous year should be for minimum 365 days and above. Then such person of Indian origin or an Indian citizen who comes in India for visit purpose, will he be considered to be a resident? Answer is yes. So that is one amendment which was being introduced in the last year, that amendment part. Now apart from that, the one students, he is a resident, will he also be considered as a resident and not ordinary resident? Will his status will be that of RNNOR? Answer is yes. So that as per that amendment, his status will that be of RNNOR students. So just keep that in mind. RNNOR will be the status. The second amendment, as you all are aware, is in respect of an Indian citizen who is actually a non-resident as per section 6.1, who is actually a non-resident as per section 6.1. So 6.1a has introduced a specific provision which says that if in the case of an Indian citizen, the total income excluding the income from point number 1, the total income excluding the income from foreign source exceed rupees 15 lakhs. Point number 2, this Indian citizen is not liable to tax. Students, is not liable to tax in any other country by way of what? By way of his domicile or other particular criteria. If he is not liable to tax in any other country, then in that particular case, this particular Indian citizen will be deemed to be a resident in India. Okay, so this 2 criteria should be looked upon very carefully. One is just that his total income excluding the income from foreign source is more than rupees 15 lakhs, and this Indian citizen is not liable to tax. This is a phrase, students, that you should always keep in mind, liable to tax. Now, I think there is already a Finance Act 2021 has made this amendment which has told you what you mean by the term liable to tax. So students, if supposingly in the foreign country the income is charged to tax, but then there is an exemption which is available in that foreign country, then what we will say? We will say that this person, is he liable to tax in the foreign country? Answer is yes, he is liable to tax in the foreign country. If after the charge he is entitled for any exemption in the foreign country, then yes, he is liable to tax in the foreign country because the income was chargeable in that particular country. So please be very careful and never change the phrase liable to tax with another phrase liable to pay the tax. Keep this particular point in mind, students. Liable to tax should not be reversed with another phrase liable to pay the tax. I hope that all of you are clear with this one. Any doubt, students, in the case of individual? Now again I'm telling you what kind of question you will get it in the exam. Students, I'm repeating to all of you. This question of the individual residential status, I will tell you, students, they will try to link this one with your double taxation avoidance agreement treaty. Students, they will try to link this one with the relief provision. So there could be a possibility wherein they can try to do a relief provision in this case. They can try to do a relief provision, students, in this case. So just keep that particular point in mind. Also, if you remember, there is an NRI. NRI is a person who is an Indian citizen or a person of Indian origin. Even in that NRI chapter also, there could be some sort of this particular residential status provision that can be applied in the NRI topic as well. Now, this was all about the residential status. Foreign company, students, I think you would have done it. If not, then directly do one question of the Butler. Directly do that question of Mr. Butler. For the foreign company, directly the poem concept. Directly write that question name Butler. Directly, don't read the theory. Directly that question Butler. Now comes in section 9, income which is deemed to accrue or rise in India. Now, as per section 911, if you see, business connection is one, and second one, students, is the indirect transfer. Business connection is one, and second one is, students, the indirect transfer. Now, in the case of business connection, students, as you all know, there is inclusive and exclusion. Inclusion is for the agent presence in India, which will give rise to a business connection to the non-resident. The presence of the agent in India may give rise to a business connection in India. That is point number one. And that agent should perform the following activity on or behalf of the non-resident. And which is the activity? He should habitually play a principal role which should lead to a conclusion of the contract. He should habitually play a principal role which should lead to the conclusion of the contract. That is point number one. Second activity of the agent happens to be, he should be storing the goods and deliver the goods as per the instruction of the non-resident. And third one is, he should be securing the order on behalf of the non-resident. So if the agent is performing any one of the following three activities, these are three activities. If the agent is performing any one of the following three activities, then yes, the non-resident will be said to have a business connection in India, and accordingly, the income arising from such business connection will deem to accrue or rise in India. That is the point. Now, there are also exclusions, students. Like, there are some 5 exclusions which are being given to you. In that exclusion, students, just always keep in mind, in your examination you will write this particular word. Which is that word? He is, like purchase of goods. He is merely purchasing the goods for the purpose of export. So the activities or confined, use the word confined. The activity is confined to purchase of the goods for the purpose of export. So this word confined means that is the only activity, that is the only business activity that is being carried out. So that is the importance of this particular word confined. Be careful. Apart from that, the other activity was the activity which is confined to shooting of cinema films. Now, in that case, there is certain condition about that the producer, who is, if he is an individual, then he should not be a citizen of India. Or for that matter, if they are partners, again the same way, should not be resident in India, Same way, if he is a partner in this context, partnership firm, then no partner in that particular partnership firm should be a citizen of India. And also for the company. So that is for the shooting of the cinema films. The third one, students, if you talk about it, but after the cinema films, the next one which was being there about the news. So in the India, you are taking the news for the purpose of putting across outside India. So again, the activity is confined to take the news from India for the purpose of publishing it outside India. So even that will be considered as what? As a case of the exclusion. So even this would be considered to be a case of the exclusion. And the last one, students, be careful on the last one. Last one, remember, that is the merchant act, the miner. That is the person who is in the business of mining. And that person who is in the business of mining, he is he is putting the uncut diamond in the exhibition at the place which is notified by the central government. He is putting the uncut diamond in the exhibition at the place which is notified by the central government. So therefore that activity also will not result into any business connection in India. Please be careful. This again is limited to this activity is confined to publish or putting the uncut diamond for exhibition. Now this exemption is applicable to whom? This exemption is applicable only to the person who is in the business of mining. Because ICI, one question, I think all of you are aware, one of the question of the ICI students, as you may be aware, has told that this particular person is engaged in merchant trading. He is a merchant trader of the uncut diamonds. So merchant trader will not be getting the benefit of this exception. Now students, significant economic presence. Students, one important point which has been there is the concept of SEP, significant economic presence. Students, this is the most important concept of the SEP. One of the most important concept of the SEP. Now what is SEP? So if supposingly the non-resident does not have a physical presence, but the non-resident have an economic presence, whether the economic presence will give rise to a business connection in India, and the answer is yes. Can you tell me, students, the parameter of economic presence? What are the threshold of the economic presence? What is the threshold for the economic presence? Quickly, students, while I take up the question now. SEP criteria. What is the criteria of the SEP? When the presence will be considered to be a significant economic presence. What are the criteria, students? Abhishek. Students, as you may be aware, for this significant economic presence, so if supposingly in respect the non-resident is earning from a person who is in India and the total goods sold is for a consideration of more than rupees 2 crores, the aggregate consideration charge to the person in India is more than rupees 2 crores, then will result into a significant economic presence? Yes. Even if the non-resident does not have any physical presence, he may not have any branch in India. Even if he does not have any branch in India, the very fact that he has successfully sold his goods to the Indian customers who are present in India, and the total turnover, the total consideration, the aggregate of the consideration paid by the customers in India is more than rupees 2 crores, then that will result into a significant economic presence. The second particular point, students, is about the number of users. Supposedly there is an app which is there, and the app is downloaded by many Indians who are resident in India, and the total number of users who are there in India who has downloaded the app is, say, more than rupees 3 lakhs. So the very fact that the app has been downloaded by Indian customers and the total number of users who are there who has downloaded that app is more than 3 lakhs, even that results into a significant economic presence of the non-resident. So even if he does not have any physical presence, the fact that he is having a significant economic presence, this is the criteria. Either the consideration of in respect of the goods sold to the Indian customers is more than rupees 2 crores in a particular financial year, or the number of users who has downloaded the app would be for more than rupees 3 lakhs. So in that particular case, you can say that yes, the non-resident do have a significant economic presence, and accordingly, students, this will result into a case for students, a business connection in India. Now, the next and the most important particular question is on the indirect transfer. I will directly take you through the practical, students, because only now this is relevant for us. Practicals on indirect transfer, students. This is expected question, students. So therefore, there would be a foreign company. The focus would be on the foreign company. The foreign company, students, there is a foreign company, and that particular foreign company, students, has transferred. That particular foreign company, students, has done what? So this foreign company, students, has transferred. If you all see in this context, so this particular foreign company has transferred the goods to the Indian subsidiary. So if this foreign company has transferred the goods to the Indian subsidiary, so just allow me 2 minutes. In the meantime, you can just have a look to this particular question. Just a second. Students, now see, have a look to this particular part. So you will have a foreign company which would be there, and obviously there would be another non-resident who would have transferred the share of this particular foreign company, and this foreign company would have made certain investment in India. So just follow this combination. In the examination, you should be getting this combination. So if you get this combination, immediately you should realize this is a question for the indirect transfer. Now accordingly, the entire focus, students, is on this foreign company. And you need to identify in this case is that whether the foreign company, does it derive its value substantially from the investment made in India or from the Indian asset. So what is to be seen is whether the foreign company, this foreign company, does it derive its value substantially from the investment made in India. Now substantial test. Now in fact, friends, just pay attention. The ICI can make a googly tomorrow in your examination. So just be very careful about this. Generally, students, obviously we are all talking about Vodafone. The ICI is yet to target the Vodafone case law in its real form. Just to secure your thought process so that you don't make a blunder in the examination. Students, supposingly there is this case, India. Now just answer me this quickly, students. There is FCO 2, there is FCO 1, and then there is a non-resident in US. Now this has made the investment, so it's a 100% holding company. Accordingly, this is also a holding company of FCO 2, and thereafter it has made investment in Indian asset. So asset is in India. Okay. Now here, thereafter, students, what has happened? This non-resident is transferring the shares of FCO 1 to non-resident 2. to non-resident 2. If this is a question combination that they are giving it to you, the only thing which, because obviously Vodafone was 14-layer company. Here we are only talking about what? Here we are talking about, students, this particular case of two-layer company. Because up till now, you may be aware that we were only discussing that there is a non-resident, there is a foreign company, and then there is an investment made in India. Please tell me the substantial condition that is talked about, the substantial condition in this case will be determined for FCO 1 or FCO 2. The substantial condition in this particular case will be determined in respect of FCO 1 or FCO 2, students. Quickly, in the examination, once this question would be there, the substantial condition that would be considered would be for FCO 1 or FCO 2. Azim. So obviously, first of all, this we have to establish. Students, first of all, we have to establish for FCO 2. Be careful. FCO 2 is deriving its values. Just keep in mind this part, students. Is the substantial condition has to be considered here. Please pay attention here. Substantial condition has to be satisfied for FCO 2. And if the substantial condition is satisfied for FCO 2, what is the net result? Net result would be that the shares of FCO 2 is deemed to be situated in India. Deemed to be situated in India. That is what it will be. Will be deemed to be situated in India. The shares of FCO 2 will be deemed to be situated in India. And therefore, can we say, if that is the case, can we say then FCO 1 is having an Indian asset, a deemed Indian asset. FCO 1 is holding a deemed Indian asset. Which is the deemed Indian asset? FCO 2. FCO 1 is holding a deemed Indian asset, FCO 2. Thereafter, then you have to see that whether this FCO 1, which is holding a deemed Indian asset of FCO 2, whether the shares of FCO 1, whether the shares of FCO 1, is it deriving its value substantially from the deemed Indian asset, which is FCO 2? Whether the shares of FCO 1 is deriving its substantial value from the deemed Indian asset, which is FCO 2. If you say yes, sir, the shares of FCO 1 is deriving its value substantially from the deemed Indian asset, which is FCO 2, then even FCO 1 will be deemed to be situated in India. Even the shares of the FCO 1 will be deemed to be situated in India. And accordingly, this NR1 will be said to have transferred the shares of FCO 1, which is nothing but a deemed Indian asset as well. Okay, so this is how these ICA will play the trick tomorrow in the examination. Chances are very high. So students, just be clear, 2-level case company. Here, my suggestion would be that ICA would be very smart enough. They will give you only share capital for FCO 1 and what? FCO 2, investment in FCO 2. Only these two would be given. Share capital in FCO 1. This is the data of balance sheet. Share capital and investment in FCO 2. So ultimately, it will boil down to whether FCO 2 derive its value substantially from the Indian asset. If FCO 2 derive its value substantially from the Indian asset, it is deemed to be situated in India. Then in that case, if this is deemed to be situated in India, we can safely say that FCO 1 is having a deemed Indian asset. And if FCO 1 is having only a deemed Indian asset, we can also say that FCO 1 is deriving its value substantially from a deemed Indian asset, which is the investment in FCO 1. Which is the investment in FCO 2, sorry. And by virtue of which a non-resident will be deemed to be considered in this case. Okay. Now students, two particular thing in the examination. Now this is a simple question of NR, which is Barbara in this case. And second one, the foreign company, students, in this case, the foreign company, who's the foreign company? The Mauritius company. So Mauritius company is this and the Indian company. Now here, students, you have to be very careful. The Mauritius company. Does the Mauritius company derive its value substantially from the Indian asset? Does the Mauritius company then this will come to students in this context. Just a second, students. Students, just a second. So here, ultimately, students, what we will have, it would be that non-resident who is there. This non-resident who is transferring the shares of FCO 1. Just always keep in mind this. FCO 1, does it derive its value substantially from the investment in India? Now, obviously, this question is comprehensive. Two things are required to be seen: when to test and how to test. So, which date you need to test the substantial condition, when to test the substantial condition, and how to test the substantial condition. So, when we do test the substantial condition, so for that purpose, you have to see whether the total book value of the Mauritius company on the two dates. Which are the two dates? The date of transfer of its shares by the foreign company, that is Barbara and C. That is one date, and the next date is the last date of the accounting period preceding the date of transfer. The last date of the accounting period preceding the date of transfer, which is generally in this question, is 31st of December. So for Mauritius company, the last date, the accounting period preceding the date of transfer is 31st of December. So therefore, in this case, the date of transfer is 31st of March. The Barbara and C. has transferred the shares. The Barbara and C. has transferred the shares. Mohit, I will be taking the slump sale, but a bit later on. I will be taking across slump sale, but a bit later on. So let me first finish off this one. So students, this 31st of March 2022. 31st of March is the date of transfer, and the last date of the accounting period preceding the date of transfer is 31st of December. Check the book value of the Mauritius company between these two dates. On 31st of December, students, the book value is 25 crores. The total book value of the Mauritius company is 25 crores. The total book value of the Mauritius company on the date of transfer 31st of March is 30 crores. So we have got the total book value as on these two dates. So accordingly, does it exceed by more than 15%? Does it exceed by more than 15%? And the answer is yes. And since it exceeds by more than 15%, therefore we go with the date of transfer as our relevant date. So once the relevant date is freezed, so on 31st of March 2022, now we have to see the substantial condition. Now what is the substantial condition? The substantial condition is this, that the fair market value of the investment in the Indian asset should be more than rupees 10 crores. The FMV value of the Indian investment should be more than rupees 10 crores. So who has made the investment? This foreign company, the Mauritius company. The fair market value of the Indian investment should be more than rupees 10 crores. That is point number one. And second point is that the fair market value of the Indian investment should be at least 50% of the total fair market value of all the asset of the foreign company, which is the Mauritius company. The total fair market value of all the assets. So therefore, friends, in this case, the investment, if you see in this question, very clearly it has said that this non-resident Barbara through the foreign company has made investment of 20% in that Indian asset. So they have got a stake in the Indian asset through this foreign company, the Mauritius company. They have taken the stake of 20% in that Indian asset. So therefore 20% of the fair market value of the Indian asset. Now this fair market value of the Indian asset is 180. Now is there a corresponding liability also? Yes, which is how much? 20. So as we know, friends, in the indirect transfer, the concept of fair market value is very unique, and if there is any corresponding liability, that liability needs to be added back, and accordingly the fair market value of the fair market value of the fair market value of the Indian asset is 200 crores. How much is the investment of Mauritius company? 20%. So 20% will result into 40 crores. So 40 crores is the investment of Mauritius company in that Indian asset. So accordingly, is it more than 10 crores? Yes. Question number 2 is it at least 50%? Is the fair market value of the Indian investment, is it at least 50% of the total fair market value of the foreign company? So the total fair market value of the Mauritius company is 50. And if the total fair market value of the Mauritius company is 50, so you can just see 40 divided by 50, it is 80%. So therefore we can say that both the conditions, both the substantial condition, one is the absolute condition of fair market value of the investment in the Indian asset is more than rupees 10 crores? Yes. The fair market value of the investment in the Indian asset, is it at least 50% of the total fair market value of the foreign company, which is Mauritius company? Again, the answer is yes. So therefore, in that case, we can say that the foreign company, which is the Mauritius company, derive its value substantially from the Indian asset. And since it's derived its value substantially from the Indian asset, what is that we will say? The shares of this foreign company is deemed to be situated in India. And the fact that the shares of the foreign company is deemed to be situated in India, we will say accordingly, students. What is that we are going to say? We shall say accordingly that the non-resident, the Mauritius company, the Mauritius company has deemed to have transferred what, students? They have transferred a capital asset which is situated in India. So whether the capital gain will it be deemed to accrue as in India? And the answer is yes. Now students, this question is an ultimate question, because here this question also involves you to calculate how much is the capital gains that you need to calculate, that needs to be considered. So calculation of the capital gains, students, first of all, the asset the capital asset that you have transferred, students, is the shares of the foreign company. The capital asset that you have transferred, students, is the shares of the foreign company, isn't it? So now the capital asset that you have transferred is the shares of the foreign company. In that particular context, if you see, the capital asset that you have transferred is the shares of the foreign company. Do you all get this one? Now the fact that the capital asset which is transferred is the shares of the foreign company, accordingly, what is that we will say? Is this long term or short term? How do I identify? This would be considered as an unlisted share so far as India is concerned. Can you agree to this one? All of you will agree to this one. Is this an unlisted shares in India? Listed, unlisted has to be from the perspective of India. Is it an unlisted shares in India? And the answer is yes. And because it is an unlisted shares in India, accordingly we will say, students, it is a long-term capital asset. Accordingly, students, we will say that it is a long-term capital asset, students. Is that clear to all of you, students, in this context? And how do we say it's a long-term capital asset? The period of holding is more than 24 months. So in just a second. So students, in this context, Namrata, assessment I already have done it. Namrata, if you see the special class today in the morning itself, you will find I have done this assessment procedure in Hindi. तो अगर आप स्पेशल क्लास अगर आप देखोगे तो आपको मिल जाएगा उसके अंदर असेसमेंट प्रोसीजर का। वो मैंने अपील्स, रिवीजन, रेक्टिफिकेशन, रिव्यू, उसका मैंने रिवीजन लिया है मॉर्निंग में, पेनाल्टीज का लिया है, स्पेशल क्लास में आपको मिल जाएगा। सो स्टूडेंट्स, in this context, I'll just tell you one thing. So it's a long-term capital asset. Is it a long-term capital asset? Students, is it a long-term capital asset? Yes, because the period of holding, because it's an unlisted share as far as India is concerned, and because it's an unlisted share so far as India is concerned, the foreign company, is it listed in India? Answer is no. And the fact that it is not listed in India, students, I will be comparing 1st of January 2020, because this is the date when the non-resident has acquired the share. So date of acquisition is 1st of Jan 2020. And when it has transferred the shares, It has transferred the shares on 31st of March 2020. So it has transferred the shares as on 31st of March 2022. So the period of holding, is it more than 24 months? Is the period of holding more than 24 months? Because that is what is the criteria for the unlisted security. The criteria for unlisted security, the period of holding should be for more than 24 months. And because the period of holding is for more than 24 months, therefore we will say, students, therefore we will say that it's a long-term capital asset. And the fact that it's a long-term capital asset now, the fact that, students, it's a long-term capital asset, therefore now the next point will emerge. And what is the next point, students? The fact that it is a long-term capital asset, therefore in this context we will say that you will do the capital gains calculation. Whether the indexation in this case, whether the indexation, will that be applicable in this context? Whether the indexation, students, will that be applicable in this context? And the answer is no. And why is it so? Because if you see over here, the indexation benefit primarily will not be applicable for the reason being, be careful, just keep in mind, students, over here, this is a very important provision. As per section 112, in the case of transfer non-resident, the long-term capital gains on the unlisted security, which is Mauritius company, is not listed in any stock exchange in India, is chargeable. Now, an unlisted security, if that is transferred, which is a long-term capital asset, students, be careful, there will not be any indexation that will be applied on the index. There will not be any indexation will be applied, and the long-term would be calculated. The long-term capital gains will be calculated without applying the indexation, and the rate would be 10%. And the rate would be 10%. So this is what it is in this context. Now, if you see over here, friends, in this context, have a look on this particular point. Long-term capital gains attributed to the asset located in India. This is what it is. Now, just one last point, students. Last point. Students, the long-term capital gains, if you see, you have calculated without indexation. So, selling price is 50 crores, cost of acquisition 10, and 40 is the long-term capital gains. But be careful, only 80% of the shares of the Mauritius company is 80% of the value of the shares of the Mauritius company is from the Indian asset. The 80% of the shares of the foreign company, students, is from the Mauritius company, isn't it? And therefore 80% of the shares primarily is from the Mauritius company. So obviously the capital gains to the extent of only 32 crores is what is deemed to accrue as in India, because 20% of the value is from the other assets, which is not an Indian asset. So whatever is the capital gains, students, that you will calculate, be very careful on one thing, that on that capital gains only apply the ratio. Which ratio? The ratio of the proportion of that particular percentage on which it is deemed to accrue as in India. And the proportion is how much, students? The proportion is 80%. So 80% would be 32 crores. So 32 crores is the proportion, and on that 10% will give rise to 3.2. 10% will give rise to 3.2. And this is how the things has to be looked upon. Fine, students. So this is what it is. We have done with this particular point. Now then, students, apart from this, keep in mind the other part. The other income, students, is 915, 916, 917, which I feel for tomorrow's paper, students, this may not be that important, but for interest and dividend, and maybe for royalty, some other things are important, which I'll discuss with all of you. Last attempt, students, if you see, they have targeted 44DA and 115A, if you can recall that, in the last attempt. So I don't find that in the current attempt, next attempt, tomorrow's paper, they will have anything much on royalty and FTS so far as the practical questions are concerned. But one case law is there, students, that is very expected in tomorrow's paper, which I'll discuss with all of you. And interest and dividend income. Students, the interest and the dividend income, as you all are aware, just keep in mind this part. For interest and dividend income, students, as you all are aware, we have discussed this particular point and I'm repeating this point again. Just keep this particular point in mind. So if you see over here, students, for dividend income of non-resident, as you all are aware, there are two rates which has been there. If the question is silent, 20%. 20%. The dividend income, 115A is the rate. Dividend is 115A, 20%. Now, apart from that, students, you also are aware that there is a 10% if what? If the non-resident has received the dividend. Received a dividend from? Dividend from whom? Receive the dividend from the business trust. Receive a dividend from the business trust. Okay, and the business trust has received from the SPV, and this SPV has taken the route of 115BAA. So if the SPV has taken the route of 115BAA and thereafter the SPV has distributed a dividend to the business trust, then that business trust, who will then pass on the dividend to the non-resident, the rate at which the dividend will be taxed will be 10% in the hands of the non-resident. Otherwise, if the question is silent, simply put, you will apply only 20% rate of tax. So there is two rates. One is 20% rate if the question is silent, dividend earned from a domestic company. From a domestic company, students. And this one, in this context, is the dividend which is earned from a foreign company. Dividend which is earned from that business trust. And that business trust will be, that business trust, students, will be so business trust in this context, students, that business trust has taken the route of 115BAA. So in this situation, students, because of 115BAA, students, finally we will conclude what? That in this context, this is what would be the 10% rate. I hope that all of you are clear with this one. Any doubt, students, in this case? If the question is silent, students, see, if you are receiving the what Abhishek is asking, the question is silent about the business trust giving the dividend amount to the non-resident, to the business trust is giving the dividend to the non-resident. What is the assumption that we'll do? We can take the assumption of 115BAA. We can take the assumption of 115BAA that the SPV has, it is assumed that the SPV has taken 115BAA. It is assumed that the SPV has taken 115BAA route. Okay, that assumption you can take. Now, interest part, students, be careful. So in this particular context, if you see now with interest rate is, students, always keep in mind, 20% is the rate when the loan given in foreign currency. 20%. Again, I'm talking about 115A, students. 115A. Now, apart from that, we have got 5% rate and 4% rate also in 115A. Now, 5% and 4%, as you can recall, students, it is in respect of three important things: long-term infra bond. Long-term infra bond. The second one, students, is about what? The first one is about the long-term infra bond. The second one is about the business trust. The business trust, if supposing the interest income has been received by the from the business trust, and the third one, students, is in respect of the rupee denominated bond, RDB, rupee denominated bond. In that three cases, students, in these three cases, the interest income would be assessed at the rate of 5%. And where these securities are listed in IFSC, if these securities are listed in IFSC, then in that situation, students, the interest will be taxed at the rate of 4%. Always keep that in mind. I hope that all of you are clear with this one. Now they can put a googly in the question, students. The googly in the question would be that the non-resident is earning, be careful, students, over here. Students, here, NRI, just typical cases of NRI, non-resident. In the past attempt, what they have done, I'll just quickly tell you. Students, NRI, I've told you in the morning also, there is a special chapter, chapter 12A. Chapter 12A, students. Now in chapter 12A, if you remember, if you utilize the foreign currency to purchase a specified asset, utilize the foreign currency to purchase a specified asset. Now that specified asset, foreign currency which has been used for the specified asset. Now that specified asset, if you see, is the shares of the company. Shares of the company. Now this is any company. Okay. Debentures or deposits of a public company. Now in one of the question of the ICI, students, be careful. In one of the question they have said that in this case, the question was that the non-resident Indian has utilized his foreign currency. Foreign currency was being used to purchase the debenture of a private company. To purchase a debenture of a private company or a deposit of a private company. And from that debenture, the non-resident is getting the interest income. So question therefore is whether chapter 12A is applicable in this case. Chapter 12A, remember what is the rate, students, in this case? Are you aware of the rate in chapter 12A? Chapter 12A, students, has got two rates. One is 10% rate and another is 20% rate. 10% rate is for long-term capital gains. And the 20% rate, students, the 20% rate is in respect of the investment income. Investment income arising out of the specified asset. The 20% is the rate for the investment income arising out of the specified asset. That is the 20% rate. So in that context, students, 20% is for the investment income. Okay. So here, the interest income, will it be taxed as per chapter 12A? In this case, answer is no. Why? Because it's a private company. But this interest income will go under 115A. And in 115A also the rate is 20%. So as such, the answer will remain the same, but you will get a 0 mark if you tax this particular interest income as per chapter 12A. If you give the reference of chapter 12A, your answer is wrong. So just ensure that IC has done it in the past. Don't make the mistake in the examination. So this interest income, students, will be taxed. This interest income will not be taxed under chapter 12A because this is from a debenture, investment in debentures of a private company. Investment in debentures of a private company. So the interest income will not be subject to chapter 12A rate, which is 20%, but the interest would be subject to the normal rate of 115A, which is also 20%. So rate wise, it becomes the same scenario. Rate wise, students, it becomes the same scenario. Did you all got this one? I hope that every one of you are clear. Now in one more attempt, students, what they have done is that the debenture, the investment in debentures were issued by Indian company to non-resident in INR. Meaning thereby the non-resident has not used the foreign currency to make the investment in the debentures in India. So if the non-resident has not used the foreign currency to make the investment in India, students, it doesn't matter, Abhishek, doesn't matter. Listed, unlisted has got no relevance. The debentures were issued by Indian company to non-resident in INR, students. So in this context, if it is issued in INR, then even 115A will fail. Because 115A, 20% is the rate if the loan has been given in the foreign currency. If the loan has been given in foreign currency. So if there was one question of Red Limited, there was a question of Red Limited. In that question of Red Limited, this particular point was being there. This particular point was being there, and I'll just show you this only one sentence, and then we'll move on to our next discussion. Red Limited, friends. This question of Red Limited, just one point. So here, interest on 8% debenture for rupees 40 lakhs issued by Blue Limited. So there was a debenture was issued by Blue Limited in consideration of providing technical know-how. So here the non-resident Red Limited has provided the technical service. And in relation to this technical service, the consideration was paid by the Indian company in the form of debentures. So can we say that the non-resident has utilized the foreign currency to invest in the debentures in India? Did the non-resident utilize the foreign currency to do the investment in India? To do the investment in the debentures? Answer is no. So the debenture was not subscribed by utilizing the foreign currency. And since the debentures was not subscribed by utilizing the foreign currency, the interest income that was received, the interest income that got accrued, that will not be subject to tax under 115A. The tax would be at the rate applicable to the foreign company, and the rate applicable to the foreign company is 40%. The rate applicable to a foreign company is 40%. Apart from that, there is a pro rata calculation also that will be involved from July 1st, 2021. July 1st, 2021. So a pro rata calculation also would be applicable over here. Is that clear to all of you? Means for 9 months, 9 by 12. Up next one, students, here. Next one, students, over here. What needs to be looked upon? So just keep in mind. If you see the next particular point, equally very important. Over here is this. If you see the next particular point, equally very important over here. Students, just pay attention to this one. Students, if they give you that the non-resident has got they will just try to confuse you that the non-resident has got a P in India. This P in India can influence only which income? This can only influence royalty and FTS. Huh? Just only till tomorrow you have to remember this. This P can influence only the assessment of royalty and FTS. The assessment of royalty and FTS gets influenced by the existence or non-existence of the P in India. Because then we have to decide whether it will go in 115A or it will go in 44DA. That is how we have to keep a decision, isn't it? So that is the point that you should keep in mind. Apart from that, students, the second one, which is equally important, is that what about interest and dividend income? Students, what about the interest and dividend income? Whether the interest on dividend income earned by the non-resident, will that be influenced, the tax rate, will that be influenced by the existence of P in India? Will that get influenced by the existence of P in India? And the answer is no. It will never ever get influenced by the existence of the P in India. That is a point that you should always keep in mind. Fine. And now, students, the last one, students. Yeah, so that is irrelevant as we have discussed. So this has got no relevance as far as that is concerned. And the last point now, students, is about the exemption to file the ROI. See, the exemption to file the ROI. There are three exemptions. Exemption to file the ROI by the non-resident. Now, if you see therein, there are three cases of the exemption. Three cases, the prominent cases of the exemption to the non-resident. One is about this 115 BBD. Sorry, what was the non-resident sports person? What is the section number for non-resident sports person? 115. This one is about Chapter 12A, BBA, sorry. 115 BBA, NR sports person. Okay, and the third one is about the case where, 115 BBA. The third one, students, is the case, Ritya. Third one is a case where the non-resident has only what? Dividend, interest, royalty, and FTS, and which is assessable under 115A. They are assessable under 115A in the bracket I'm writing and not DTAA. Be careful on that, because if the treaty rate is more beneficial, then the SSC will have to file the return. Mandatory. Apply the logic. Why the treaty will become, why this will become mandatory? Because apply the logic, students. The logic is just that in this particular case, then we will have to see whether he is eligible for treaty or not. And for that purpose, will have to file the return of income? And the answer is yes. So that is the reason why they are very categorically mentioning that the assessment should be done under section 115A of these income, and the TDS has been deducted. TDS has been deducted as per the Act rate. As per the Act rate. So as per the Act rate. So be careful 115A that they have mentioned, because royalty and FTS can also be assessed in 44DA. If royalty and FTS is assessable under 44DA, then whether the exemption under section, exemption to file the ROI, will it be available? And the answer is no. Then in that particular case, the exemption to file the ROI will not be available if it is having also royalty and FTS income as a part of it. As a part of it, students. So therefore, even that is one of the point that you should always keep in mind in this regard. Okay. So TDS has been deducted as per the Act rate. Now TDS, students, goes without saying. Again, last point, students, TDS, you all know, if the NR is the payee, NR or the foreign company, if they are the payee, okay, and the TDS is as per the Act rate. So just keep in mind, TDS is as per the Act rate, not the treaty rate. The TDS is as per the Act rate. Then what is the conclusion? The conclusion is that we have to load. There is a loading of HEC. HEC on the Act rate. So HEC at the rate of 4% has to be loaded always in the TDS rate. So we will get the effective rate. But if the applicable rate is the rate as per the DTAA, being more beneficial as compared to the treaty rate, then in that case we will have to ignore HEC completely. We have to ignore HEC completely. Okay. Here also the same situation is that only 3 income of the for the non-resident sports person, and TDS is deducted. TDS is deducted as per the Act rate. As per the Act rate, TDS is deducted as per the Act rate. So therefore, students, in this case, students, chapter 12, if you see, chapter 12, students, chapter 12, students, if you see over here, then what we will say in this context, the non-resident has got, the non-resident has got the 2 income. Which income? The LTCG and that income of the investment income. LTCG and the investment income of chapter 12, and the TDS has been deducted. TDS is deducted as per the Act rate. Again the Act rate, everywhere Act rate, only then you will get the exemption. Then in that case also the exemption is applicable. Then in that case also the exemption is applicable. So this is how the things has to be looked upon in this scenario, students, and that is how the things has to be considered. I hope that all of you are clear with this one now. Every one of you. So students, this is how the things has to be looked upon now. We are done with this particular proposition completely now. With that, now let's move it forward over here. Students, now then, in this regard, if you see over here now, the students, in this regard, students, let's have a look to this one. All of you through any query in this case? All of you through any query, students, in this case? Shall I proceed further? Perfect. Now let's, students, I'm just putting the discussion further quickly now. Students, one last particular criteria is about this particular concept of the case of onshore and offshore. Now students, just hold on. Students, over here, the concept of onshore and offshore. This is the last particular point, just keep in mind because this is also equally important. Now students, supposingly, here the deemed accrual students, just keep in mind the deemed accrual in respect of dividend, the deemed accrual of dividend which is there is in respect of from domestic company. The deemed accrual of interest, royalty and FTS in this case. So if the payer, deemed accrual in India, should always keep this particular point in mind, deemed accrual in India, if the payer is a government, students, then it is always deemed to accrue in India. Always deemed to have accrued in India. Isn't it? Always deemed to accrue in India. That is the point. If the payer is government for interest, royalty and FTS. At the same time, if the payer happens to be resident or non-resident, then the deemed accrual in India will take place when the deemed accrual students will take place in India, in the deemed accrual will take place if what? If the business or the source for which the payment is made, if the business or source for which the payment is made is situated in India, for which the payment is made is situated in India, students. So then and only then the deemed accrual will take place. So if the payer, who is a payer? Payer is a resident or a non-resident and the payment is in respect of the business or a source situated in India, then in that case we will say that yes, then there is a deemed accrual that has taken place in India. Then we will say that there is a deemed accrual that has taken place in India. But if somebody will have to say that no sir, the payer is the payment is in respect of a business or a source outside India. The payment is in respect of a business or a source which is outside India, then the income will not be deemed to have accrued or rise in India. Then the income will not be deemed to have accrued or rise in India. Is that clear to all of you students? So this is the point that you should always be careful in this context, okay? This is the point, students, that is you should be very careful on this context. Now, apart from this one, students, the next particular point. Apart from this one now, students, the next particular point which is to be considered is this. Be careful now. So this is about a deemed accrual, students. I have already mentioned to all of you in this regard. Now, apart from this now, students, there can be a case wherein they can tell you that supposingly the payer is making the payment in respect of the business or a source which is situated in India, but the NR has not, in this case, the NR has not rendered the service in India, students. They are giving it to you in the question that the non-resident is paying, the payer who is a non-resident or the payer who is a resident, they are making the payment of interest, royalty or FTS income to the non-resident in respect of the business or a source which is situated in India. But the non-resident has not rendered any service, rendered the service in India. Has not rendered the services in India. This is one point. And second is that the non-resident does not have what? The non-resident does not have P in India. Will have any relevance so far as the deemed accrual of that income in India is concerned? Will it have any relevance so far as the deemed accrual of that income is concerned? To that the answer is no. Once the payment is made for interest, royalty and FTS, and the payment is made by resident and non-resident, and the payment is made for the business or a source which is situated in India, then in that case, what is the conclusion? Conclusion is that then it is irrelevant now to further determine whether the non-resident has actually rendered the service in India. It is also irrelevant to now determine whether the non-resident has got P in India. So these are the irrelevant criteria. I hope that all of you are clear with this one now. If that be the case, students, let's proceed further in this regard. So there are a couple of questions wherein they will tell you that 50% of services the non-resident has rendered in India and 50% of services he has rendered from his own foreign location. And he has raised 2 invoices. You will say that doesn't matter. Both the invoices, the services for both the invoices will be deemed to have accrued in India because the payer, say for example, the payer is a resident in India, he is making the payment in respect of the business or a source which is situated in India. Fine, students. So this is what it is, students. Now the next particular point, students, as I was telling to all of you, one last question, students, which is there, and that is a case law. Which case law, students? Royalty and FTS. Students, the case law on the royalty, if you remember the case law which I was talking about it, computer software. Students, computer software. Computer software, students, in this case, in this scenario, students, have you done this case law, students, from my case law lecture? This computer software case law. I will just, students, in the Telegram channel, I will tell you the timing of this computer software. It's a 5 minutes, students. It's a 5 minutes lecture. Just we will ensure to do that 5 minutes class. 5 minutes class. In the Telegram channel, in the afternoon, I will just tell you this particular case law range. Do that tomorrow. You will remember me once you find this case law in the examination. Do that. You will remember me, students. Okay, 5 minutes. I will just make a reference in the Telegram channel immediately after the lecture gets over in the afternoon at 3 o'clock. Fine, students. Now then, it's a 5 minutes. Just ensure to go through that once, and that should be all. Now, after this, students, the next particular point is a DTAA. No, if it is arising, Abhishek is asking if income is arising outside India and the payment is made from India to non-resident. Doesn't matter. The payment is made outside India. The payment is not made in India. Like for example, there is a popular question where there is an agent of a buyer of a supplier in India. The agent is situated outside India. The role of the agent who is situated outside India is to find out the prospective buyers outside India. The payment of the commission is made to this particular agent outside India. Question is where this particular agent who is based outside India, where he is providing the services are provided outside India. And the fact that the services are provided outside India, therefore the commission is deemed to have accrued outside India. Now obviously the commission would have remitted to a bank account which is situated outside India. The commission would have been remitted by the supplier in India to a bank account which is situated outside India. And therefore, can we say even the accrual has taken place outside India? Can we say even the accrual has taken place outside India? And the answer is yes. Even the accrual has taken place outside India. I hope that all of you are clear with this one now. Students, every one of you. Now, students, the foreign tax credit, quickly I will tell you that critical part. Now, critical part of foreign tax credit part. Students, just pay attention to this one. Now, the next point after this thing is foreign tax credit. Students, first of all, there is this rule number. Students, there is this rule number 115. If the question, the way June 2021 attempt question was there, the ICA acted very smart. So, if they give it to you, students, in the question that there is a foreign income and the foreign income has been given to you in dollars, foreign currency. Obviously, the credit, the tax credit, the relief through the tax credit, you all are giving by virtue of, students, the relief through tax credit you all are giving by virtue of the provision, the relief of the tax credit, students, you all are giving to a resident. The resident, that's a criteria of the foreign tax credit rules, that only the resident is the person to whom the tax credit will be given. Isn't it? So therefore, in India also we give the relief to a resident, and if he is a resident, then the world income will be taxable in India. If he is a resident, then the world income is taxable in India. Isn't it? One important point which I just wanted to share with all of you over here. Students, if he is a RN NOR, then if he is an RN NOR, just I told you some time back, the amendment resident, remember that? He is a resident. I told you about the amendment. Please tell me, as far as that amendment is concerned, what will be the scenario? If he is the individual is a resident, but resident and non-resident, not ordinary resident, as per the amendment that we have discussed at the start of the class. So in that particular case, whether the foreign income is taxable in India? Is the foreign income taxable in India, students? In this context, be careful, students. Answer is no. Only that foreign income which is in respect of the business or a profession which is controlled from India, only that foreign income will form part of the total income. Are you aware of that? Business or a profession which is controlled from India. Yeah, income received in India, any case it is taxable. Income which is received in India is anyways it is taxable, students, as we all are aware. But be careful. Supposedly they are talking about interest income. See, this is the googly of the tomorrow's paper. If supposedly they will tell you about the interest income of RN/NOR, if they tell you about the dividend income of an RN/NOR, so whether these interest income of RN/NOR or dividend income of RN/NOR which is earned outside India, will that be a part of the scope of the total income? Answer is no. It will not be a part of the scope of the total income. Is that clear to all of you? But what about the business or a profession? Business or profession controlled from India. Will that be a part of the total income? So if there is any business or a profession which the resident and not ordinary resident is carrying out outside India, but that business or profession is controlled outside India, then in that case, students, what will be the situation? Then in that case, students, the situation would be that will it be an income which will be deemed to accrue as in India? And the answer to that is yes, it will be. Okay, so this will be a scope. It will be falling within the scope of it. So students, be careful. There is a twist in the ICI question that if you are RN/NOR, then there definitely would be a twist in the question, students. Then there would be definitely a twist in the question. That is what I have told to all of you. Is that clear to all of you? So obviously, which income will not be considered? Interest income earned outside India, dividend income earned outside India. All this income, students, you will not consider it at all. Okay, all this income will not be considered at all. Okay, but if they tell you that okay, it is a business or a profession which is carried outside India, but it is controlled from India, then is it accrued in India? Will it be deemed to accrued in India, or will it form part of the scope for RN/NOR? Will it form part of the scope for RN/NOR? And the answer is yes. Okay, so that is what it is, students. So tell me one thing, that is there any double taxation for interest and dividend income? Is there any double taxation for interest and dividend income for RN/NOR? Answer is no. If there is no double taxation, is there any case of a relief to be granted? Answer is no. Because it will not fall within the scope itself. Where is the question of granting the relief? Are you getting this particular point? Don't make the blunder in the examination tomorrow. If supposedly they talk about RN/NOR and this is what they will have to give it to you, these informations. Only the business and profession which is carried out in India, but that is controlled from India, that is what we will say that this business and profession is accrued also in India. Then in that case, that will be falling within the scope. That is what will fall within the scope. So if that is what will fall within the scope, students, then in that situation, if that is what will fall within the scope, students, then in that situation, there could be a double taxation. And on that double taxation, that there will be a relief on this particular business or profession carried out of India, but which is controlled from India. Shall I proceed further, students, now? Now, apart from that, students, therefore, generally the question would be of RN/NOR only, RN/OR itself. And if it is RN/NOR, then the world income is taxable. And if the world income is taxable, then all the foreign income will be taxable in India. So the foreign income, students, just be very careful. If they are giving you the foreign income, which will form part of the scope of total income, if they are giving you the foreign income in INR, in the foreign currency, if they are giving you the foreign income in the foreign currency, that is in dollars, students, that is in dollars, students. So if they are giving you the foreign income in the foreign currency which is in dollars, then in that particular case, students, be very, very careful. If they are giving you the foreign income in the foreign currency, then that foreign income which is a part of a scope of the total income of this resident and ordinary resident, then we will have to first convert into INR. What is the conversion rate? Keep this in mind. Dividend income, interest income, capital gains income, and salary income. Repeat with me. Dividend, interest, capital gains, and salary income. This 4 income, you will take the TT buying rate of the last month, of the last date of the preceding month. You will take TT buying rate as on the last date of the preceding month. Preceding to which month? The month in which these income have become due or have accrued. These income have become due or accrued. So the month in which the dividend, interest, capital gains, salary has become due or has become accrued, you will go to the preceding month, and of the preceding month, take the last date, and of the last date, TT buying rate. Whatever is the TT buying rate, apply the TT buying rate conversion factor, and that will give you the INR amount. Is that clear to all of you? So please do the first step, that if the foreign income is given to you in foreign currency, then first and foremost is to convert it into INR. First and foremost, friends, you will have to convert that into INR. Is that clear to all of you? And once it is converted into INR, thereafter you will start calculating the total income. And there will be some provisions that will be given to you, that they will give you that, look, this particular deduction is not allowed as per the foreign laws. As per the law of the foreign country, this deduction is not available, or this set off is not available as per the law of the foreign country. All these becomes an irrelevant criteria, students. All this will become an irrelevant criteria. Completely ignore it. You will have to completely ignore all these nonsense. Why? Because your computation will be completely based on what? Based on what is the law as per the Indian Income Tax Act 1961. So if under the Indian Income Tax Act 1961, if these deductions are allowed, if these set off are allowed, then you have to give them those deductions in set off. Is that clear to all of you? And that is how you will compute a total income. Now once you calculate a total income, do the tax liability calculation. Don't forget the surcharge. If you are an individual, you all know, more than 50 lakhs, more than 1 crore. Now there is an angle of 115 BAC also. Chances are very high, because this is one point which the ICI is now, I think they are trying to play around on 115 BAC. They will tell you that this individual, now chances are very high, tomorrow in the paper you will find that this individual resident has opted for 115 BAC. Then there is a game. Game would be that supposedly he has got a house property income. Now you tell me, if there is a house property income, then there are certain restrictions. What are the restrictions, by the way? The SOP property, tell me one thing. The SOP property will get the deduction in respect of the interest on the loan borrowed? Does the SOP property, students, quickly, does the SOP property gets the deduction in respect of the interest on the loan borrowed, which is of rupees 2 lakhs? Do they get it? Students, quickly. Abhishek? Answer is no. So these are tricks that these people are going to apply. So only the LOP, if I have opted for 115 BAC, then the interest deduction is restricted only to LOP and DLOP. Isn't it? Now, if you can have a look to the page. If you want to have a look quickly, you can keep on flipping the page. Parallel students, keep looking at the page also. That will be helping you to revise simultaneously. Secondly, the salary income. Chances are very high that he would have the salary income. Then there are also some block deductions over there. Like for example, the standard deduction. Standard deduction is not available. So these are the factors. And chapter 6A, because sometimes they will give it to you that chapter 6A is there. Isn't it? ATC, ATD. But here may what happen? It may so happen that ATC, ATD will not be available. Why it will not be available? Because there is a block deduction. If you have opted for 115 BAC, then you don't get ATC and ATD also. So therefore, those things will not have to be considered, because this is what their trick will be played in the tomorrow's paper. Okay, so that is how you will then calculate the total income. And then the tax liability, the slab rate is also different. The slab rate is also different, students. Isn't it? At every increase of 2.5 lakhs, the rate also starts increasing. So we have seen the slab rate in the case of 115 BAC. You can also quickly switch on to the slab rate and see the difference yourself. So these are the ways in which this tax liability then will have to be calculated. What about the rebate of 87A? Rebate is available of 87A, not an issue. What about the surcharge? Surcharge is the normal surcharge, 50 lakhs above, 1 crore above, 2 crores above and 5 crores above. That is how the normal rate of surcharge would be applicable if the total income as computed under 115 BAC exceed the thresholds. So thereafter, after you calculate the tax liability till HEC, whatever is the tax liability that you have calculated, then you take the average rate, which is nothing but the Indian rate. And what is the average rate? The tax liability till HEC divided by the total income that you have computed, and that will give you the Indian rate or the average rate. Now this Indian rate or the average rate, would be compared with the foreign rate, and whichever is lower will be applied on what? On that portion. Be careful. On that portion of the foreign income. Which is subject to what, students? Which is subject to double taxation. Be careful in this case. Double taxation in both the countries. That portion of the foreign income which is subject to double taxation in both the countries. Now, again, a quick example. Students, like for example, rental income in the foreign country, the rental income earned in the foreign country, in that foreign country, they have deducted the TDS, students. They have deducted the TDS. Yes, it is available. Abhishek. The rental income which has been earned in the foreign country, on that the TDS is deducted. The rental income earned in the foreign country, the TDS has been deducted. Now it is on the rental income, which means that it is on gross basis that the tax has been deducted in the foreign country. On the gross basis, the tax has been deducted in the foreign country. Whereas in India, the rental income will be subject to further deductions, and only the net amount of the annual value will form part of the total income. Only the net amount of the annual value will it form part of the total income, and the answer is yes. That is how we will have to consider it. So the rental income, on that rental income, students, TDS would be deducted. And what is the rate of TDS? I think all of you are aware of it. Sorry, they will give it to you in the question. The TDS rate which is deducted in the foreign country. And in India, we get deduction of municipal tax paid. So whatever is municipal tax paid in the foreign country, you will get deduction of that. Whatever is standard deduction, 30% of NAV, you will get deduction of that. And also, if there is any interest of that one, you will get deduction of that. So my point is that this is a net annual value. This net annual value is going to be a part of the total income. And on this total income, that the tax would be paid in India. On this total income, the tax would be paid in India. So what is the portion of the foreign income? Which is subject to double taxation in India? This is the portion of the foreign income and not this one. Because this particular rental income is on gross basis, whereas this is the net portion of the foreign income which form part of the total income on which the tax has been imposed in India. So the portion of the foreign income on which there is a double taxation, which is this much. So this is what will be considered finally in our calculation. Clear to all of you, students? So on this amount, students, you will apply the Indian rate or foreign rate, whichever is lower. In this amount, you will apply the Indian rate or foreign rate, whichever is lower. Are you clear with this one, students? Are you all clear with this one? One very quick point, if we will have to just see one question which has been there, let's have a look to one quick question and then let's move on. So here is a case of Mr. Kalpesh, who is of age 56 years. A resident individual furnishes the following particulars of income earned by him in India and country T for the previous year 21-22. India has not entered into DTAA agreement with country T. Doesn't matter. Read further. Income from profession carried on in India, 6 lakhs. Agricultural income in country T, taxable. This is also going to be taxed in India. Dividend from a company incorporated in country T is 1,20,000. So dividend from what? From a company which is incorporated in country T, students, is how much? 1,20,000 rupees. Royalty income from literary book from country T, students, please tell me. 3,80,000 QQB. 3,80,000 QQB, isn't it? Expense incurred for earning the royalty. Now, whether this expense which is incurred in earning the royalty, will that be allowed as deduction? Answer is yes, it will be allowed as deduction. Students, please be careful. There is one more royalty of resident. I told you in the morning also 115 BBF. For 115 BBF, I already told you in that royalty income of 115 BBF, which is for the patent income, patent box. So the patent which is registered in India, please be very careful. That patent income is assessable on gross basis at 10% under 115 BBF without any deduction of any expenditure. Didn't I told you about this one? Without any deduction of any expenditure. This is what it happens over 115 BBF. Fine, so this is what we have discussed in this context. I hope that this point is very clear. But this is for the copyright. This is for a copyright royalty earned by a resident from foreign country for which 80 QQB deduction would be allowed. 80 QQB deduction would be allowed. Okay, is there any special rate of tax for it? Do we have any special rate of tax for this kind of royalty income? Answer is no. And if there is no special rate of tax on this kind of royalty income, will the expenditure which you have incurred to earn this royalty income, will this expenditure that you have incurred to earn this royalty income, will that be allowed as deduction? Answer is yes. The expenditure accordingly will be allowed as deduction, students, and that is the point. So this expenditure will be reduced. Business losses country T 75,000. As per income tax law of country T, business loss is not eligible for set-off against any other income. The rate of tax, students, is 20%. But in India, it will be eligible for set-off. Not only that, we will do a set-off. We will also give, not only that, we will do a set-off, students. We will also give 80 QQB Chapter 6A 3 lakhs deduction. We will also give 80 QQB Chapter 6A deduction. Do you all agree to this one? Not only that, we will also give, students. Not only that, students, we will also give another deduction. So this is for 80 QQB. Deductions of 80 QQB, students, for which we will give the deduction. Not only that, there is one more deduction which is of the expenditure which is incurred to earn this royalty income. Even that deduction will be given. So thereby the net income which is taxable in India will be a lesser amount. So the double taxation would be that lesser portion of the amount which finally be a part of the total income. The double taxation would be the lesser portion of the amount, and only in respect of that portion of foreign income which is subject to double taxation in both the country, only in respect of that portion of foreign income which is subject to double taxation in both the country, that we will get that relief. I hope that every one of you are clear with this one. Every one of you are clear with this one, students. I'll run through quickly the solution over here. Professional income 6 lakhs minus the business loss 75,000. Agricultural income country T 75. Let me in fact directly calculate for you the last point. The last point, students. See here. The last point only I'll calculate, students. The foreign income which is subject to double taxation. Which is the foreign income? The foreign income is agriculture income 75,000. Fine. This is taxable in India. Thereafter, dividend income from country T 1,20,000. 1,20,000. Royalty income 4 lakhs. Now this 4 lakhs would be reduced by 60. Will also be reduced by 3 lakhs. So finally, the net would be how much, students? 40,000. Only 40,000 would be left in this case of royalty. Business loss of 75,000 would be reduced. Business loss of 75,000 would be reduced, students, in this case. So finally, students, if you see over here, what is that we will get it? The net income which is subject to double taxation would be how much? 120 and 40, 1,60,000. So the net foreign income, can I say this as a net foreign income? Net foreign income which is charged to, which is subject to double taxation in both the country. Which is subject to double taxation. How much is that? 1,60,000. And of this 1,60,000, I will apply which rate? The foreign rate they have given you 20%. The foreign rate they have given you 20%. Whereas the Indian rate is how much? 8.826%. So obviously Indian rate is much lower. So 8.826% will be applied on that foreign income which is subject to double taxation in both the country. So the relief would be of 8.826% on that 1,60,000, and finally the amount of relief is 14,122, which will be given from the tax liability. How much is the tax? This tax liability, which is till HEC, which is 67,080. Till HEC, which is 67,080. then finally the tax payable is 52,958. Please do the rounding off. Are you aware there is a rounding off? You get half marks. Are you aware of this one, students? Half marks is given. Tomorrow you will remember me for this. Tax payable is 58. Do a rounding off to the nearest 10. Nearest 10, not 100. Don't do of 100 and come. So do a nearest 10. Even for total income, there is a rounding off. Here there is no requirement, but I am just telling you, even for total income, you need to round it off to the nearest 10. Although here there was no requirement to do the same. Is that clear to all of you? Half mark is given for this particular purpose. Fine, students. Now I am just telling you last point, students, here. Please pay attention. Please pay attention here. Students, ICI question. Now just 2 or 3 typical points and we will close this chapter now. 2 or 3 typical points and I am going to close this chapter. And thereafter we will jump into transfer pricing practical questions. We'll jump into transfer pricing practical questions. Students, here. First is ICI question if they are giving you a single rate of foreign country. So the problem is that there is no issue then. If a single rate is been given of a foreign country, that is 20%, then simply put, what you have to do, students? Simply put, in that case, students, you will have to then compare. You can consolidate everything because there are 3 to 4 sources in this question, like agricultural income, like dividend income, like royalty income, like business. There were 3 to 4 sources of the income which was there in this question. And as I told you, students, in this case, we will have to consider, we are consolidating everything. We are consolidating everything. So, since we are consolidating everything, students, in this context, the final conclusion would be, students, what is the final conclusion? The final calculation, students, in this particular context will be that we are consolidating everything and thereafter calculate whatever is the portion of the foreign income, the consolidated foreign income on which there was a double taxation in both the countries. What is the portion of the consolidated foreign income on which there is a double taxation in both the countries? Consolidated. Why consolidated, friends? Because I already told you now, I am repeating this again. The consolidated because the rate of tax was same in both the countries. Clear with this one? Now the challenge would be when there is, for each source there is a different rate. And if for each source there is a different rate of tax in the foreign country, then what you need to do? Then you have to go source wise. So you will have to calculate for each source what is the portion of the foreign income from that particular source on which the tax was paid in both the country. What is the portion of the foreign income from that source on which the tax was paid in both the country? You will take that portion of the foreign income from that source and the foreign income taken from that particular source, you will then apply what, friends? The lower of the two rates. Which is the lower of the two rates? The Indian rate, and compare that with the foreign rate which is for that particular source, and lower of the two will be applied on that. So similarly you will do for the another source also, the same way, same working. That you will calculate how much from that particular source, how much of the foreign income from that particular source has been subject to double taxation in both the country. That is what you need to do even for that particular income. Did you all got this one? Students? I hope that every one of you are clear with this point now. Every one of you are clear with this one. And this is what you will have to thereafter, but you have to do the calculation for each source if the rate of tax for each source is different. Now, at the same time, if supposedly they are giving you 2 countries, this was a question that they are giving it to you only for one country. But what if the question is for 2 countries then? So if the question is for 2 countries, then for each country, you will do the separate calculation. So from that country, what is the portion of the foreign income? What is the portion of the foreign income on which there was a double taxation in both the country? You will select that foreign income, and on that foreign income, apply the lower of the 2 rates. That is the rate. For the rate applicable in that country will be compared with the Indian rate, and the lower of the 2 rate will be applied on that portion of the foreign income. And similarly, you will do it also the similar calculation for the another foreign income as well. This is what you will do it, and that exactly is the point. I hope that every one of you are clear with this for now. No confusion whatsoever, students. So we are done with the practical also. With that now, let's proceed further, students, in this context. I am now going to the transfer pricing chapter. Students, transfer pricing chapter. Now, Abhishek, what should be the strategy of total income? Question of working notes. The strategy should be do the adjustment, add less as it comes, and write the answer. Write the note just in the bracket itself below that adjustment. Write the note just below the bracket itself. Did you got this one? You will have to write the note just below the bracket itself. I hope that all of you are clear with this one then. So in that bracket itself, you will have to write the notes. Clear with this one? Now, just below the adjustment. Okay, just below the adjustment. Now, after that adjustment, before you start the next adjustment, some of the students' handwriting is not that good. So it is strongly advised to leave one particular line and thereafter write the next adjustment. Thereafter do the next adjustment, students. Now, I am coming to the transfer pricing, students, quickly on the methods of the transfer pricing, students. On the methods of the transfer pricing, and in the case of the methods of the transfer pricing, students, let me in fact take you through that. In the case of the methods of the transfer pricing, students, students, I will be dealing with the two methods, students, which is the resale price method, cost plus method. These are the two methods, students, for which the ICI has got these two questions. So let me quickly run through those two methods for all of you. Resale price method and the cost plus method, which is the two methods which the ICI has given it primarily. So let me run through on those two methods in this case. Now the theory, students, I have told you that please keep for 1 hour, 45 minutes for the theory and 15 minutes for GAR, 50 to 20 minutes for GAR provision. So that is what you will do it. I will give you the link if you want. The link is already there of this theory, both in English as well as in Hindi. So just take it 1 hour time for the general antibodies rule, practicals, and thereafter 20 minutes for the GAR, particular 20 to 25 minutes for the GAR practicals, and the remaining is the theoretical part. 45 minutes stops, for which you can take it in the speed mode also, doesn't matter, but just go through them and that should be all. Students, onward chalega, only the keywords has to be captured, only the keywords. Question number 2, if you see, students, over here, this was a question which was there in this I can expect question number 2 tomorrow or question number 4. One of the two questions can be there for tomorrow's paper. Why is it so? Because you all are aware these are the two new questions in the module. So this is a case of a resale price. This is a case of a cost plus method. Let's have a look in this context. A Limited is an Indian company at Pune and it provides the software development services to various customers and also to its associated enterprise B Company Limited, Miami, USA. So that is what it is. So it billed rupees 2 crores for software development service rendered to B Company Limited during the year 2021-2022. The total cost, direct and indirect, incurred for executing the work was rupees 175 lakhs. So already this cost needs to be top up with the margin as required in the cost plus method, and the margin may require the adjustment of the uncommon factors between the two transactions, that is the unrelated transaction and the international transaction, that is the transaction with the AE. So the uncommon factors of the two transactions needs to be adjusted in that margin percentage. By the way, you take the margin percentage of the comparable uncontrolled transaction. Of that comparable uncontrolled transaction, you take the margin percentage, and of that margin percentage, you will do the necessary adjustment in relation to the uncommon factor. Now, this adjustment that you do of the uncommon factor, students, one point which is there, you have to do the adjustment in such a way that it aligns to that margin percentage should finally aligns to all the factors which are otherwise available in the international transaction, that is a transaction with the associated enterprise. So that is what you need to always ensure on. That is what you need to always ensure upon, isn't it? So let's have a look over here. So the cost has been given to you is 175 lakhs in the case of unrelated parties. For similar services, A Company Limited earned a gross profit of 50 crores. So comparable margin has been given to you as 50% of the cost. The following distinguishing feature are observed between the transaction with the related party, that is B Company Limited, and the other unrelated party. So now the uncommon factor begins. B Company Limited provides the technology support to A Company Limited. So in that case, the associated enterprise is providing what? The technology support to A Company Limited. Its software development project assigned by it. In case of unrelated party, the value of technology support expenditure for similar project would be how much? Would be rupees 17,50,000. Now students, in this particular context, if you see 17,50,000. Now if you see over here, please tell me one thing. In the case of A transaction, the technology support is given. In the case of the associated enterprise transaction, in the case of the international transaction, the technology support is given. If the technology support is given, you have to tell me that then in that particular case, whether this will result into the reduction in the price or not. If the technology support has been given, then whether it will result into the reduction of the margin or not. Whether the A, if I'm getting the technology support from you, so in the price which I'm going to charge, will the margin would be on the lower side? Yes, why not? Margin has to be on the lower side because you have given me the technology support, and therefore when I will charge you the price, the margin has to be on the lower side. Now this technology support is not there in the associated enterprise transaction, and if it is not there in the associated enterprise transaction, the margin in the A transaction is on the higher side. And what did I told you? You need to align with the factors which is available in the A transaction. You need to align to the factors which are available in the A transaction, and that is what you need to do. So you will align to the factors which are there in the A transaction, and that is the reason why, students, as I told you, will you now also reduce the margin of the uncontrolled transaction as well? Will you reduce the margin of the uncontrolled transaction as well? And the answer is yes, you will. So how much reduction will be required? So 70,50,000 is the amount. If the amount is 70,50,000, how much vis-a-vis the total cost? This vis-a-vis the total cost is how much? 10%. So 10% vis-a-vis the total cost. So therefore, this is the amount as compared to total cost, it is 10%. So 10% will have to be reduced from 50%. So that this gets aligned to the factors which are there in the A transaction. Point number 2. A company limited gave discount of 10% to B company limited, and this benefit is not given to outside customers. A company limited, students, is giving the discount to B of 10% to whom? To B company limited, and this benefit is not given to outside customers. So if A is giving the discount, obviously the discount also will reduce the price. And if the discount reduces the price, then it will also reduce the margin. Now this is not there. This discount is not there in the unrelated party transaction, for which the margin charge is 50%. So therefore now that 50% has to be adjusted with the discount criteria. And how much is the discount? That needs to be adjusted 10%. So therefore 10% of the discount also has to be adjusted from this particular part. So we will adjust this 10% discount as well in this context. Coming on the third particular point, A company limited carried out marketing function in respect of transaction with B company limited and incurred rupees 13,12,500. So in this case, A company limited has carried out marketing function in respect of transaction with B company limited and carried out and incurred how much? 13,12,500. This marketing function is not normally provided by A company to outside. Now A is providing marketing. Now if I am providing marketing to you, so in that case, will I be charging more to you? If I am giving the marketing to you, you are not giving me. You are a customer. You are, up till now, first 2 points. In the first case, the technology support you gave me. But here in this case, I am giving you marketing support. So if I am giving you marketing support, will the price be on a higher side? Yes. Now, is this marketing support available in the other transaction? Unrelated transaction? No. So the margin is not with the marketing function. So therefore, I need to make the margin of the unrelated transaction taking into account this marketing support. And therefore, in that case, will the margin needs to be enhanced? And the answer is yes. So what we will do in point number 3, the margin, students, will be enhanced in this case. Now, how much it will be in this criteria, students? So 13,12,500 divided by 175 as a percentage of cost. How much it is? As a percentage of cost, it is 7.5%. 13,12,500 as the percentage of cost is 7.5%. So add 7.5%. This is the addition that you need to do over here. I hope that every one of you are clear with this one. So this is the addition in the margin percentage that needs to be done. And the last point number 4, A company limited provides extended credit period at the cost of the credit. And the cost of the credit period is 2.5%. So if I'm giving you bits to my international transaction to B company limited. So to the B company limited, I am giving the extended credit. So if the credit is given, it will increase the price because the price will be inclusive of the financing charges. So if that is the case, the selling price will increase. If the selling price will increase, accordingly, will the margin will also increase? And the answer is yes. So in the case of transaction, in the case of the international transaction, it is inclusive of the credit. It is inclusive of this particular credit. Whereas in the case of unrelated transaction, where the margin percentage is 50, this is without the credit factor. And therefore, if it is without the credit factor, the margin would be on the lower side. And therefore, in that case, what we are going to do, we are going to add the margin for the credit factor. How much addition needs to be done? 2.5% of the cost is what needs to be added. So 2.5% of the cost needs to be added. So therefore, finally, the markup on the cost is 40%. So this 40% will be added on the total cost of 175 lakhs. And therefore, I get what? The markup margin of 70. Accordingly, the ALP of 245 lakhs against the ALP of 245 lakhs means what? This is the price which the Indian AE should have charged to the B company, that is a for non-resident AE. Whereas how much actually the price has been charged? 200, and therefore 45 is finally the transfer pricing adjustment. 45 finally is the transfer pricing adjustment. Now if you see question number 4 over here, what it says: Bharat Cell Phones Limited, BCL of Mumbai, and Japan Mobiles Limited, JML of Tokyo are associated enterprise. BCL imported 10,000 mobile handset from JML for rupees 15,000 per handset. which are sold to unrelated party in India at rupees 20,000 per handset. This is the selling price, students. Now BCL also imported similar mobile set from Europe Limited of London, which was sold with a gross margin of 25%. This is important now. This is 25% on cost. So if it is 1/4 on cost, how much on selling price then? 1/4 on cost, it means 1/5 on selling price. 1/4 on cost, it means that 1/5 of selling price, isn't it? Which means 20% of the selling price. So this is a 20% of the selling price is the resale price margin. See, in the cost plus method, you require margin as a percentage of cost, whereas in the case of resale price method, you require margin as a percentage of selling price. You require margin as a percentage of selling price. So this will be a 20% on this selling price. JML offered quantity discount at 2,000 per unit, and whereas EL offered quantity discount at 800 per unit as a quantity discount. And thereafter the freight. Now, in the resale price method, just let me tell you one important point. In the case of resale price method, what happens? Be careful. What happens in the case of resale price method? Please pay attention to this one. Now, here unrelated party is supplying you the similar goods. Pay attention to it over here. Unrelated party is supplying you the similar goods, and that similar goods is resold. So first thing, you have to calculate the resale price margin. You have to calculate the resale margin as a percentage of sale price. Now here, that's the reason why as a percentage of sale price in my question, it becomes 20% of selling price. 25% on cost means 20% on selling price. Because thereafter, here before I start applying point number 2, see, if you have your non-resident A, so NRA, so this is your NRA, with who has done the supply of the goods to the Indian A, and that Indian A would have resold the goods further. That Indian A has resold the goods further, isn't it? So thereafter, students, once you get the resale price margin percentage from the unrelated party as a percentage of sales, you will then apply point number 2. Whatever the goods which has been resold by the Indian A further, the goods which has been resold by the Indian A further, of that you will reduce the resale price margin percentage, which in my example is 20%. So that will be reduced. The resale price margin percentage will be reduced. Thereafter, students, if any additional expenditure would have incurred on importation of the goods by the Indian A, then obviously that additional expenditure so incurred will also be reduced. The additional expenditure so incurred would also be reduced in this regard. The additional expenditure so incurred would also be reduced in this regard, students. That you all got this one. All of you. Fine. And then thereafter, students, if you see over here, point number 4. Now you are at this stage. Be careful, students. You are at this stage. Now point number 4. Adjustment relating to the uncommon factor. Now, once you have reduced the margin percentage, then as such you have arrived at the seed. This is a seed, students. The Indian A. Now the Indian A at this particular point of time, you will then adjust any uncommon factor between the purchase price, between the purchase transaction from the non-resident A and what was the transaction which has taken place over here. So whatever is the uncommon factor, you will adjust in such a way, students, that the price which you have determined in step number 2 or step number 3, that should be aligned to the factor. With factor, the factor of the A transaction, the international transaction. So therefore, after step number 2 or step number 3, as the case may be, do ensure that if there is any uncommon factor between the two transactions, then that uncommon factor needs to be adjusted. That uncommon factor, students, needs to be adjusted in such a particular way. That uncommon factor, students, needs to be adjusted in such a particular way that finally the factors which are there, in the international transaction, that factor gets captured in the ALP. That factor should get captured in the ALP. So accordingly, students, if you see this particular question, what has happened? So in this question, students, if you see, which has been given to you, see over here. So as I was telling you, so first is 25% is the 20% is the margin percentage. The 20% is the margin of the selling price. So which is 4,000 rupees. The 20% is the margin of the selling price, which is 4,000 rupees. Now the resale price, which I told you, which the Indian AE has done. So here BCL has imported 10,000 mobile phone, which is Bharat Cell phone, from JBL. Who's JBL? JBL is the associated enterprise person, and which was resold. At what price it has been resold? By the Indian AE. The price at which it has been resold by the Indian AE is 20,000. What was step number 2? Step number 2 is the price at which the goods are resold by the Indian AE. From that price you will reduce what? The gross margin percentage, which is of the unrelated transaction, and the percentage would be percentage of the selling price. So therefore from 20,000 of the price at which the goods are resold by the Indian AE, I am reducing 20%, which is the gross margin arising from the uncontrolled transaction. And by virtue of this, students, we will have 20%. So I'll get 16,000. Now if you see the uncommon factor, JBL offered quantity discount at 2,000 per unit, and whereas EL offered quantity discount at 800 rupees per unit as a quantity discount. So please be careful over here. So the quantity discount in the case of Japan is more of 2,000, whereas quantity discount in the case of EL is less. So therefore on the ALP which I am determining now, ALP I have to give more quantity discount. So how much excess quantity discount that I need to give in the ALP which I am determining? The excess quantity discount is 1,200. That is what I will reduce it further. Similarly, in respect of purchase from JBL, the expenditure towards freight and custom duty was 500 per unit. Okay, just about that. The freight and custom duty for import from EL had a cost of 1,500 per unit. So that is a freight. From which one? From EL had a cost of to the BCL. How much cost that the BCL has incurred on the import done from the unrelated party? From the unrelated party, the import from the unrelated party on the import, the freight that they have to incur was how much? 1,500. Whereas in the case of JBL, the freight that they have to incur is how much? 500. So this is less, whereas this is more. In this context, this is less, whereas this is more. Do you all agree to this one? So in this case, in the case of international transaction, lesser amount of freight is what is charged, whereas their higher amount of freight is been charged. So the purchase price, which is the ALP purchase price, which is of the unrelated party, obviously with the higher purchase price the margin would be less, and if the margin would be less, then in that case the lesser amount of reduction would have happened of the amount. So therefore what I need to do, I need to reduce this higher extra amount of freight which I have incurred in the ALP transaction or the unrelated transaction. So how much is the extra amount of the freight in the purchase transaction of the unrelated party transaction? The extra amount of freight which I have incurred is 1,000 rupees. That extra amount of freight of 1,000 rupees needs to be reduced, and that is what will give me finally my ALP. That is what will give me finally my ALP, and this is the ALP which will then be compared, and accordingly you will get this price. I hope that all of you have got hold with this one. So these are the two particular methods which I considered to be an extremely important. And last one method, students, transaction net margin method. You will look into it at your end. TNMM method, as per the explanation whichever I would have given, should just ensure to wrap it up, and that should be all. With that, now students, we enter into the amendment part. And the amendment part, students, we will take into account. So CG, students, please tell me, are you keen on the CG part, or else we will close this one? Just let me know. CG amendment, if you would require, because in any case we just have completed CG amendment some time back. Please tell me, students, on the CG amendment front. Students, CG amendment front. My suggestion, therefore, students, would be that if that be the case, yes, that's what it is there. We have already covered the CG, students. I will suggest you just wrap it up, because I think this is important that you just now wrap it up at your end. The CG particular amendment part, I will suggest that because we just have recently covered up these amendments and all, along with the practicals. It will hardly build. If you get stuck, students, you will just try to put across this thing in your observation. So, students, 147 also we have covered it. Just now, the video is there. Have you seen this one, Abhishek? 147. I think you have not seen the 147 amendment. 147 also we have covered it. Hear it. Have you seen the amendment video of 147, Abhishek? Quickly. So my suggestion, hear it. I will suggest that 147 also, if it is possible for you people. Okay, the key issues. As such, see, the key issues is about the time limit. The key issue is also about the process. 2-3 things are there. One is the process, another is the time limit. There are two things which have changed drastically. So what is the process so far as 147 is concerned? Let me take you through that quickly then. Now, first and foremost, if you can have a look. Assessment which has been there over here. Regular assessment 143, 144. Now the special assessment earlier that we had. That we have, students. 147, and we also had the 153A to 153C in assessment in consequence of search. Now that particular assessment in consequence of search has been merged with what? Has been merged with the assessment of 147. That has been merged with the assessment of 147. So this is what is the amendment that has taken place. So before and after, this is the biggest change that has taken place. Is that clear to all of you, students? Now even the normal reassessment, which earlier also was done under 147, now also will be done under 147. But more importantly, the assessment in consequence of search, which was earlier done only under a separate code of 153A to 153C, now will be executed under section 147 itself. So 147 is the Uniform Civil Code for the reassessment under the Income Tax Act, or the income escaping assessment under the Income Tax Act. Fine. Now, apart from that, students, there are certain important changes that has taken place. We will look into that in this context. So the language, students, is the first paragraph itself. Just keep in mind the first paragraph language, and thereafter these 3 boxes. I think after that the things will become very similar. So if any income chargeable to tax in the case of an SSE has escaped the assessment for any assessment year, the assessing officer may, subject to the provision of 140 to 123, assess or reassess such income. Such income means the income chargeable to tax which has escaped the assessment. Okay, shall reassess such income or recompute the loss or depreciation allowance. Okay. So if any income chargeable to tax has escaped the assessment, please use this particular phrase in 147. I had this phrase for 147 for tomorrow's examination. Please write 2 times. If any income which is chargeable to tax has escaped the assessment, then the AO shall assess or reassess such income, students, or recompute loss or depreciation for such assessment year. Okay, so he shall assess or reassess such income. Okay, subject to what? Subject to the provision of 140 to 153. Now, apart from that, can the AO can also reassess any other income which comes to his notice during the course of the proceedings? And the answer is yes. So that can also be done. So the AO may also assess or reassess the income in respect of any issue which has escaped the assessment, and such issue comes to his notice subsequently in the course of the proceedings under section this thing. So even that can be assessed or reassessed. So this is the point. In other words, AO may assess any income in respect of any issue that has escaped the assessment, which comes to his notice subsequently in the course of the proceeding, even if the steps prescribed in section 148A is not followed. Obviously, for the original income which has triggered the reassessment, for that original income you need to follow the steps which is given to you in 148A. But subsequently, during the pendency of proceedings, if there is any new income, which income? The income which is chargeable to tax and which has escaped the assessment, if such new income has been identified during the pendency of the proceedings of 147, then for that we can directly do the assessment without taking the trouble of doing the procedural part of 148A. Thereafter, students, just have a look to 3 boxes and then 148A procedural part, and then we'll move on. If any income chargeable to tax has escaped the assessment for any AO, the AO may assess or reassess or recompute, and then thereafter, students, he may also assess or reassess the income in respect of such issue which has escaped and which comes to his notice subsequently in the course of the proceedings. In such case, the compliance stipulated of 148A is not necessary for this particular new income. Is that clear? Now, what is the procedure that needs to be followed? For this procedure, as I told you, needs to be followed for the original income. For the original income, for which you need to start the proceedings of 147. So here, first of all, the assessing officer has to follow the steps given under before issuing the notice of 148A. 148, he needs to do the following steps, and these steps are given to you in 148A. Conduct any inquiry if required with the prior approval with respect to the information. So if you have got any information which suggests that the income has chargeable to tax has escaped assessment, you can conduct the inquiry. For this purpose, the AO may invoke the powerful two sections, and that is section 131 and 133, wherein those inquiries can be undertaken. Students, can be undertaken. Point number B, provide an opportunity of being heard to the assessee with the prior approval of specified authority by serving upon him a show cause notice. Within such time as may be prescribed in the notice, being 7 days to 30 days. Now be careful here. So this show cause notice is for the purpose of, what is this show cause notice all about? Once you have done this preliminary inquiry on the basis of the information which suggests that there is an income which is chargeable to tax and has escaped the assessment, and you are now convinced, after the inquiry you are convinced that yes, this has happened, then you will issue a show cause notice to the assessee, telling the assessee that tell me the reason why I should not conduct the reassessment in respect of why I should not be undertaking the reassessment under section 148 in this regard. So a show cause notice should be given to you, and in that show cause notice, students, the time limit should be given for explaining the assessee should be for 7 days to 30 days. MCQ based question can be there for this time limit. So how much within that time the assessee needs to reply to this show cause notice? 7 days to 30 days. From the date on which the notice is issued, or such time as may be extended by him on the basis of the application, as to why the notice of 148 should not be issued on the basis of the information. Okay. Now, question to all of you over point number B is this, that whether that information which is there in the possession of the department, whether that information needs to be put up in the show cause notice for the assessee to explain him the reason why on the basis of this information I should not be doing a reassessment on you. Should that information, should it be put up? Answer is yes. Otherwise, how the assessee will come to know as to what is that which triggers you to give me a show cause notice of 148A, whereby you are telling me that you want to do a reassessment. How do I come to know on that? So whether that information, should it be disclosed by the AO in the show cause notice issued under 148A? And the answer is yes. Earlier it was not the case. Earlier in the old law, only after the assessee has filed the return in response to the notice of 148, only when the assessee would have filed the return in response to 148, that thereafter these information was to be disclosed. But now the AO directly can issue this, furnish those particular information to the assessee and asking him to give me the reason why I should not issue on you a notice under 148. Thereafter, he will consider the reply furnished, if any, in response to the show cause notice, and then finally decide on the basis of his inquiry, on the basis of the response given by the assessee. He will decide on the basis of the material available on record, including the reply of the assessee, whether or not it is a fit case to issue the notice under 148 by passing the order with the prior approval of the specified authority. Pass the order and then you pass the order to say that yes, it is the fit case, or pass the order to say no, it is not the fit case for 147. Whatever be the decision that you are taking now after the SSC has given its reply, you will have to pass the order, because by issuing a show cause notice over here, you actually have triggered a proceeding by itself, and therefore will you have to pass an order? And the answer is yes. So can I say, before you start the proceeding of 147, you have to start another proceeding before you start? So there is a proceeding before a proceedings. There is a proceeding of 148A before the proceeding of 147. So any proceeding starts with the notice, and that proceeding has to end by an order. And this proceedings of 148A is a proceeding for giving an opportunity of being heard. That why I should not start the proceeding of 147. So effectively 148A, students, is what? Is the proceedings before proceedings. Start with the notice and with the order. The order can be either this way or that way. That is, order can be giving go ahead to start the proceeding of 147, or the order of 148A after the reply of the SSC, wherein the AO may be satisfied with the reply, and then he would have thought that yes, there is no case of an income chargeable to tax which has escaped the assessment. It was just my misinterpretation of the events, and therefore he may choose to drop the entire case altogether by passing an order. Why, students, in this context? So students, this is what it is to be considered over here. So this is about the proceedings before the proceedings. So this is the order that has been passed. So proceeding gets completed by the order. Which order? Fit case. In this case, and thereafter, students, not a fit case. Now accordingly, now you will give the notice. Now this is if it is a fit case. If it is fit case, then he will give a notice under 148, and then thereafter return has to be filed in response to the same. Then thereafter the return has to be filed in response to the same. Now 148, this is important. When the AO need not undertake this step, when the proceedings before proceedings is not required. When the proceedings before the proceedings is not required, which means when directly you can start 147 by issuing notice under 148. When the proceedings before the proceeding is not required, in a simple word, students, remember this: if it is a search case or a requisition case, okay, a search case or a requisition case, in that situation, the search case of the SSC or the requisition case of the SSC, as the case may be, in this context, so in that situation, students, in that particular situation, you will say that now this proceedings before proceedings under 148A is not required. Directly, what can happen if it is a search case or requisition of 132 or 132A? Okay, the search can be, students, the search that has taken place or a requisition of 132A. In both the cases, students, we will not be going further with this proceedings before proceedings. I hope that this point is well clear by all of you. Straight away you will give, in this case, the notice of 148. Now specified authority, students, please by heart this one. Please by heart this one, because this is ICF favorite question of old syllables also. And what is that? In case where the 3 years, the specified authority with whom the approval has to be taken. In case where the 3 years or less than 3 years has elapsed from the end of relevant assessment year, principal commissioner. So up to 3 years kind of a thing. So from the relevant assessment year, you want to give the notice of 148 or 148A, as the case may be. So in that case, if 3 years has already, if up to 3 years, if that notice of 148 or 148A has to be issued, then the approval that has to be taken by the assessing officer has to be from the principal commissioner or principal director, or commissioner or director, as the case may be. But if it is for more than 3 years, then it is principal chief commissioner or principal director general, or the chief commissioner or the director general, as the case may be. Be careful, principal commissioner, principal director, or simply commissioner or director. if it is up to 3 years. But where it goes beyond 3 years, Principal Chief Commissioner or the Director General is the word that needs to be looked upon. Now friends, in this context, finally, if you have to see over here, so this is a situation which has been given. Now, if I have to take you accordingly, friends, over here, the information. Now, as I was telling you, the information on the basis of which notice can be issued only when the notice can be issued, the information on the basis of which AO has prompted the AO to give what? To give this notice of 148A. What is that information? So there is, the condition is that notice can be issued only when there is an information with the AO which suggests that the income chargeable to tax has escaped the assessment in case of the SSC for the relevant AY and the assessing officer has obtained the prior approval. Now, for the purpose of section 148A, the information with the AO which suggests that the income chargeable to tax has escaped the assessment means what? Information which is flagged. Flagged by whom? Flagged by the CBDT, which automatically, they have got automatic risk information system which is flagged to the internal purpose for department, and any final objection raised by the CAG to the effect that the assessment in the case of the SSC for the relevant AY has not been made in accordance with the provision of the Act. So this is for the information which has prompted the AO to pursue further any inquiry if he wants to do the inquiry, and thereafter issue the show cause notice under 148A. Issue the show cause notice under 148A and finally pass the order under 148A to decide whether it is a fit case or not to pursue further the provision of section 147. Now, the another point is about the deemed information. The assessing officer shall deem to have information which suggests that the income chargeable to tax has escaped the assessment. Now, in the deemed information, search case is there. The search case is there. But apart from search cases, a survey, if it is undertaken in the premises of the SSC on or after, just keep in mind from this date, just for the tomorrow's, till tomorrow, just keep in mind the date is 1st April 2021. Just keep in mind that tomorrow's examination, the date is 1st April 2021. Okay. Now, a survey, if supposedly search is initiated, is 132, or even a survey is initiated, students, then by virtue of the survey, will that be considered as a deemed information for the purpose of the AO? And the answer is yes. Now, you tell me one thing, that is a deemed information. So, that deemed information, the beauty of this, of the deemed information is not for 1 year. The deemed information would be considered for 3 years. The 3 AYs immediately preceding the AY relevant to the previous year in which such search or survey, just focus on this word, such search or survey is conducted. So this deemed information for this would be for 3 years. What does it imply? Will the SSC therefore, will he be required to issue the, will he be required then to file the return for the 3 AYs? Will the SSC will then be required to file the return for the 3 assessment year? And the answer to that is yes. The SSC will then be required to file the return for the 3 assessment year, and that exactly is the point, students. I hope that this point is well taken by all of you. Okay, time limit, students, as you know, 3 years is there, and between 3 years to 10 years is there. Up to 3 years and 3 years to 10 years is there. For 3 years to 10 years, students, it is only in the case of an exceptional case, and that is the case wherein the undisclosed income, the undisclosed income which is represented by the asset is for more than rupees 50 lakhs. Okay, so that is a point which has been given to you over here. So that is the thing. Now the last point, students, is this, which is very important. The missing link, students, in the entire thing, there is one thing which is an odd man out. Have you noticed this one? The last one, students, this is a chart which I'll do and we'll close it. The following flow chart attempts to provide an overview. 147. The AO is in the position of the following information, suggesting that the income has escaped. The information of two types, as per risk management and as per the CAG. But at the same time, when the AO is having deemed information, suggesting that the income has escaped the assessment for the purpose of 148. Now, what is about the deemed information, students? A search is initiated under 132, or the books of accounts or other documents or any other issue is requisitioned under 132A on or after 1st of April 2021. So search 132 or requisition of 132A. Clear with this one? That is what we have did it. And also survey. So survey also will result into a deemed information. Survey under 133A, students. Just keep that in mind. Now, in that particular case, here, if it is, tell me one thing, students, over here, in this context. In this context. Now, the third one, any money, bullion, and jewelry. Students, be careful. Here it is. Now, this is 1, 2, and 3. Now, what is this 1, 2, and 3 for deemed information? Just search in my premises has been conducted, students. Okay, and in my premises, there were some books of accounts or money, bullion, and jewelry, it was found and it belonged to you. So, search was conducted in my premises. That is point number 1. Thereafter, but it was in my premises, certain books of accounts were being found which belong to you, students. So you are with the SSC then, in this case. So it belonged to any other person. So in that particular context, so in this situation, students, in this particular situation, even on you then, there will be a deemed information. So in my case, there will be a deemed information already because the search has taken place in my premises. But in my premises, then there were certain books of accounts that was being found. And on that basis, in that case, whether on your case also, then there will be a deemed information. And the answer is yes. Why it is so important? Because in both your case, in my case, where in whose premises the search has happened, and in your case, where your books were being found in my premises, in both of our case, automatically 3 years. Students, last 3 years, return has to be filed by us. Last 3 years, return will have to be filed by us, students. That is mandatory in this case. Okay, so this is how it has to be considered. Now, tell me one thing. In this situation of search which has taken place, will this be subject to the inquiry of 148A? Will this be subject to an inquiry of 148A? And the answer is no. We have already seen that the proceedings before the proceedings is not required if it is a search or a requisition of 132A. So in your and in my case, in whose premises a search has taken place, and in your case, where your books and assets were being found in my premises, and it was being, the AO was satisfied that it belonged to you. So in both of our case, we will not expect that the department will initiate 148A, which is proceedings before the proceedings. That will not happen, students, at all. Is that clear to all of you, students? So see, in this case, cases of 1 and 3, which is search in my premises, and the books which is found in my premises for your case, compliance stipulated in 148A is not necessary. But what if in the case of in the case of survey of 133A, so in the case of survey, if that has taken place, there is a deemed information for 3 years. That is for sure. There is a deemed information for the 3 assessment year preceding the AY relevant to the previous year in which the survey has taken place. So for that 3 preceding AY, there is a deemed information. But will this be, but for that, whether the AO, will he be required to conduct the inquiry before he gives the notice of 148? Will he have to conduct the inquiry of 148A before he gives the notice of 148? Answer is yes, he have to. So the notice of 148A will be required in this case, students. And that exactly is the point, students. I think we are done with this one now. And what is the time limit to complete the order? The time limit, you can skip it, students, if you want. The time limit to skip this one, which has been there. Okay, by the way, the notice can be given for the last 3 AYs, or as I told you, the notice can also be increased from 3 AYs to 10 AYs. Is that clear to all of you, students? This 10 AYs would be happening only if the undisclosed income represented by the asset is 50 lakhs or more during that particular year. So with that, students, we are done with this. I'm just concluding this particular part now. So this is all of your reassessment of 147. Now, students, this has been done with it. Any other quick points that you want to have it, students? Now, I'm just giving you the final conclusion over here. But before that, I'll just explain this and students, just a minute of explanation of this and then the last conclusion, which I'll do it for all of you for the last time. One last particular conclusion, students, which I just need to deal with it for all of you. But before that, one important particular announcement just to have it in this context, students. Students, this is a subscription, this thing which has been there. So iconic subscription, which has been there now, I think all of you are aware of the iconic subscription, but importantly herein there is a price hike which is of 15%. Up to May 31st, 11:59 p.m. there would be a price hike. So if you in fact do it now, please tell your friends, family, if they are subscribing it now, then they will be in a position to save. Not only the price hike, plus with the code of CADS, as you all are aware, with the code of CADS, you get 10% discount additionally. Isn't it? That is point number one. Secondly, the flagship program of the iconic students, all of you are aware. The more important feature is this evaluated test series printed books which are being given to you. So apart from the normal feature of the plus, these are the additional feature which are being given. Evaluated test series for each of the paper, 40, 80 and 100%. For each of the subject, the graded test series for 40 marks, 80 marks and 100 marks as the case may be is what has been provided for. Supposedly anyone is to be taking the iconic subscription for a group, then 12 months it is this particular part, 28,800 plus with the code of CADS you get 10% discount straight away on that. Same way for 24 months and 36 months. Now friends, the last particular point which I just wanted to tell to all of you over here is this. Be careful. The last particular point which I just wanted to tell you is again this point just for the sake of repetition, so be it. But the last point over here is that please keep in mind one point, which is about that tomorrow when you have that 15 minutes extra, please try to take 2 descriptive questions. Select the 2 descriptive questions, students, first. So what you will be doing would be selection of the 2 descriptive question out of the 5. MCQ, try to do it later on. Whatever is the best descriptive question in that 15 minutes, try to select that. So that would be your first priority. Thereafter, once that has been done, then the second would be the MCQ. So that maybe you have to target 1 hour to 1 hour 15 minutes. This has to get over. That MCQ, you will always have the speed. Please don't beat around. If you see a big MCQs and all, if you find they are quite big enough and the marks allotted is not very high enough, you need to have the courage to skip some big MCQs. If supposing the marks is 1 or 2, if you think that the reading time itself would be very high, then in that case it is irrelevant for you to deal with it. And thereafter, students, after the MCQ is done, then please come to question number 1, which is also a compulsory question. This is the order of the solution, because this thing compulsory question. So that is the case. MCQ, you have to be fast because obviously the answer is already there in front of you. So please be fast when you are there in the MCQ because the answer is already there in front of your eyes. So that's the reason why I request that the MCQ while you do it, try to be at the 4th gear. Don't be in the 1st or 2nd gear while you do the MCQ because already the answer is flashing in front of your eyes. The 4 option is there in front of you. So be smart enough to get the answer by elimination technique, something of that sort. All those techniques which I have already discussed earlier also with all of you. Question number 1 compulsory should be done it now, and the last is the balance. Don't do the question number 1 at the last because then it will get messed up. I have only given you one last caution, and the last caution which I gave it to you was this, that if at all, I think Abhishek, this depends on, it is not this thing. You take at your particular this thing, whatever is comfortable, whatever is the coverage which you people have to do it, just do that. Now it's not that what should be done today and tomorrow, it's all up to you. But just try to expedite. Okay, any day expedite. Okay, that is what I'll suggest to you. And students, in this last particular point, which has been there, as I'm telling to all of you over here, please be careful. Students, if the question is really very tough, the DT paper is very tough, it is chance very high. And maybe if the DT's paper is not tough only for you, it is tough for across the country. So in that case, don't fear because it is tough for everyone then. Then the MCQ may take the center stage. Then that will become question number 1 and thereafter all the remaining question will have to be solved sequentially. If the paper is really a blinder of the question, then maybe then you can start with MCQ and thereafter you can take up selective, you can be selective enough to do all the other paper. Is that clear to all of you? I will now share with you in my Telegram channel also, students, the link of that 5 minutes case law, which is to be done, students, of that non-resident royalty taxation. Just go through that 5 minutes and that should be all. Okay, in the Telegram channel I'll just share with you. So this is the order of your execution. You will start with 2 descriptive questions, assuming it is an average paper, but always a DT paper is on the lengthier side. So it is, first question has to be 2 descriptive question, which you need to select in that first 15 minutes of the idle time that you get with the question paper. Do with that. Then you switch on to the MCQ. in that case, and maybe try to show your smartness and be at a bit of pace. Just see if some of the MCQ, if it is a lengthier MCQ with a lower marks coverage, maybe those can be skipped initially at one go. And thereafter question number 1 compulsory. After this MCQ is done and the case study, then question number 1 and finally the balance one. This is the order which you have to do it. I hope that all of you are clear with this one. All the best from my side, students. Do well in the examination. God bless to all of you. I'll catch up quickly maybe tomorrow evening. Maybe you can SMS me, message me primarily as to how was your paper. Do let me know about the same. Thank you, students. Do take care. Bye-bye.